I'd like to introduce my team of professionals that work with me. I'm Bill Hesh. I'm an attorney, CPA, and financial planner. I'm a personal financial specialist, which is a CPA that specializes in financial planning. I was very fortunate many years ago, almost 30, that I was one of the first 400 CPAs in the country that got certified as a personal financial specialist. So today, in a 50-mile radius of Cincinnati, there's only around 1% of the CPAs that are financial planners and certified with that designation. So what it means to my clients when we work with my clients is that when they come to a meeting, they have an attorney, a CPA, and a financial planner at every meeting. You have the experience that I've had. When I got out of law school, I was with Touche Ross and Deloitte & Touche in their tax department. If you're familiar with the big accounting firms, the Arthur Andersen that went under, I was a tax partner here in Touche, and after the merger with Deloitte, I left the firm. Deloitte did Procter & Gamble. I was with Touche Ross. We had 50 people in the office. Deloitte had 300. I worked with small businesses, and we had 15 people in the tax department that I was on top of, and then we had 30 people in the audit department. So I've always worked with family businesses. When I was with Touche Ross, I got involved with succession planning for business owners back with many clients, and actually was working with Touche Ross nationally when they put together the first seminar on doing succession planning for business owners and financial planning for business owners. So I have a lot of depth of experience, and that works well when I'm working with clients. Because when I left Deloitte & Touche, I was a CFO at a company, Squarey Food Service. So I worked with them for 2 years. I had a 2-year covenant not to compete. Everybody's aware of that, if you're a business owner, that you'd like to have non-competes. So I was with Squarey Food Service. So I got some really good experience with their succession plan, working within the company as a CFO, and Charlie Squarey for those 2 years. But Charlie was a client of mine for nearly 20 years. And I went through the whole gamut of his succession plan with him and his family. So it kind of gives you some background of where I come from, that it kind of makes me very unique when I'm working with clients, that I'm able to kind of be a sounding board and give clients a second opinion, that I work with their attorney, I can work with their CPA, I can work with their financial planner, I can wear the hat that they need. I have a great team of people that have been with me many years, quite frankly. The CPA practice we launched, I had my first employee back 23 years ago, was Carrie Carroll. So Carrie's in the back of the room. Carrie, she's been putting up with me for 23 years. But she's an accountant doing taxes in my office. And Kathy actually started with me back in the 80s at Touche Ross. Then she joined my practice a couple of years after I started it in 1993. And Kathy's a CPA with her master's in tax. And she was with me for several years. And then she had, she got pregnant with her 5th child after she just adopted her 4th child. So she took a hiatus and recently came back with me a couple years ago. So Kathy and Carrie is the heart and soul of my tax practice. And then we have on the law side, I have Amy Pennekamp. Amy's been with me. She'll be a speaker talking about estate planning on the 3rd session. Amy's been with me for 12 years, a Chase Law School graduate, XU grad, finance. Yeah, XU, right? Okay. So, but anyway, Amy works with me in the last 12 years, and we really have had a great opportunity in our business. One of the ironic things, I'm an entrepreneur. I'm a business owner. So that's kind of unique for most professionals out there that you work with. When I started my business back in 93 as a CPA, actually it was the 3rd time I was terminated in my career. And that was the miracle year of my life. I survived. I had to create business in a matter of actually 30 days. And so there's that story's on my website. And so very fortunate that that things worked out the way that they did. And the ironic thing is that we were able to double our business in 3 years. We were able to double our business in 3 years. We were able to double our business in 4 years. To me, whether it's the practice of law, CPA, it's all about sales and marketing, quite frankly. The key, though, is that when you're out there creating this persona and you're out there marketing yourself, the key is that the inside reality has to match the outside perception. In other words, when you bring the people in, you got to deliver, and you got to be able to produce. So I'm just trying to tell a little bit of the story, because then when Amy and I Well, when the recession hit back in 2008, I had a tax practice that all of my home builders went bankrupt. All of my contractors went bankrupt. When you're losing money in a recession in '08 and '09, there's not a lot of tax planning to do. So we focused on the law firm, and we were very fortunate in 2009, 10, 11 to double our law firm practice in the recession. We got recognized by the Northern Kentucky Chamber and the Emerging 30 as the fastest growing companies in the chamber during the recession for 2 years, in 2011 and 2012. So again, when you look at operating a business, I'm here to give you some advice about how to do some tax planning, succession planning, estate planning. But I'm very experienced because I've walked in the shoes that you are as a business owner, having to manage a business, having to go through a recession, having to start a business up out of my apartment in Fort Mitchell, Kentucky in 1993. Okay? So I've walked in the shoes of a lot of you business owners, and I know what it is when you have that responsibility. Yourself with your employees. They become family. Okay? Friedman is another attorney in my office. Chris been with me for 4 years. And again, Amy and I have continued to grow the practice, and we brought on Kurt 4 years ago. So again, with Kurt, the whole concept is I have a team of professionals. And one of the interesting things, because you might tell I'm a little bit older than they are, but one of the interesting things I think is that I take a person along with me to every meeting. And we don't charge the client for that person in that meeting. But I tell my clients, they do all the work. So when you think about it, I might have a car accident, something might happen, and all my clients have been working with my team. So there's continuity. This is part of the thing I'm going to be talking about in succession planning. If something happens, which quite frankly, I had to walk in that terror last year. I'm kind of walking, living proof that you can put Humpty Dumpty back together again. Last year, I was kind of in scared to death survival mode. I was facing back surgery in February. I was off 10 days after the surgery. I had my left knee replaced in May. I was off 2 weeks after the surgery. In October, I had my other knee replaced. I was off 2 weeks after the surgery. Now, I worked pretty hard before and after every surgery, and last year was a record year for our business. So what I'm trying to share with you is that we all have health problems that come up, and I've been really healthy for a long time, quite frankly. But last year was a year of challenging. So the thing that I would share with you is that, as a business owner, it's important that you really focus on, your health and your wellness in addition to your balance in your life, so that you can really be and do all the things you want to be for your customers, your clients, and who you serve. So with that introduction, it's time for the workshop. If you all could go into your booklet, and there's a handout here, the top 10 tax planning mistakes that business owners make. And this is intended to be a workshop. So we have identified what I found to be the top 10 mistakes that business owners make when they're doing tax planning. So these are intended to be questions that you can work with your CPA on, and you can answer as you go through it. So this is intended to be that you can be able to take away. So the tax planning mistake number 1 is the failure to find out from your CPA what your tax rate is, how much are you paying in federal taxes, state taxes, city taxes, Social Security taxes in your business. You really need to know what your tax rate is. Everybody's trying to make more money. And what you're going to find out here, depending upon your type of entity that you are for tax purposes, you may be paying significantly a lot of taxes that you're not aware of. And so part of this process, to me, when you do tax planning, is you really, as a business owner, need to know what your tax bracket is, so that when you go forward, you understand the importance of making sure you're maximizing your deductions and minimizing your taxes. So if you go into the outline, back there's behind the outline is Exhibit A, and then these are going to be tools back behind the outline. If you go to page 205 on the bottom right-hand corner, you're going to see an example of a business owner that's married, and so you might be able to also on page 3 of the tax planning guide that's in your booklet, It has the current tax rates for yourself if you're married or single. You might want to refer to that because I want you to be looking at your tax bracket. A lot of business owners are Schedule C sole proprietorships. It's not uncommon to have that tax entity, and so we're going to start there. You'll see in this example that if you're married and you're a business owner and your profits are between $75,000 and $150,000, that's your taxable income, the federal tax bracket is 25%. I'll give you an example. I had a client in last week. She is getting audited by the IRS, and she wanted to come in and review things. And it's not unusual. Her husband's making a little bit over $100,000. Her taxable income last year was $90,000. She made $32,000 of profit last year as a business owner. So when you take $90,000 and you look at $75,000, I was able to explain to her that $15,000 of her profit last year was subject to federal income tax at 25%. The amount below that, the other $17,000, almost half of it, was subject to federal tax at 15%. So that's just the starting point, though. Okay, it doesn't stop there. Look at the handout on page 2. You'll see that because she's subject to Social Security taxes as a business owner, the Social Security taxes are 15%. So half of her profit is, you pay federal taxes at 25 and 15 is 40%. The other half of her profits were being taxed at 30%. And then you have the state taxes. I say 4%, Kentucky's 6%, but you get a tax deduction for it. So if you're in a 1/3 tax bracket, I just kind of rounded it off. If you're in Kentucky, you'll pay around 4% in state taxes. Kind of interesting. Ohio changed the law a few years ago. They have the commercial activity tax that business owners are subjected to. But if you're a business owner and you're in business for yourself, you have a small business income tax deduction that you basically do not pay hardly any tax at all on your profits. Zero tax in Ohio. I've been living in Kentucky my whole life, worked in Cincinnati my whole life. I'm seriously debating I need to move to Ohio because I'll save 6% of, or if I tax affected 4% of my income, I'll save in state taxes. But as a resident of Kentucky, working in Ohio, I don't pay much Ohio tax at all because I get the deduction, but I'm still subject, all my income is subject to tax in Kentucky at 6%. I get a tax deduction for that, so it nets out to be 4%. There's also city taxes involved. My office is in Cincinnati. If you're here in Covington, different cities have 1% tax rates, 2% tax rates. But it's not uncommon. The city of Covington's 2.5%. You know, if you're in Boone County, you have Florence taxes and you got Boone County taxes. So if you're in Fort Thomas, the client that I met with had a home office in Fort Thomas. And between Campbell County and Fort Thomas, her taxes were 2%. So when you add it up, in this simple example, if you're married and your income is between $75,000 and $150,000 of taxable income, you're paying 46% in taxes here in Kentucky. If you're in Ohio, it's only 42%. That gives you a break, right? And if your income is not as much, you're still paying 36%. This lady was livid. She's trying to make, she started her business up 3 years ago. She said, what, anything I make? Because her husband uses up all the lower tax brackets. She's in a 46% tax bracket on everything she makes. Now, if she tries to grow her business $10,000, she's going to pay $4,600 in taxes. She was shocked. And I don't know what you know. So what kind of tax bracket are you in? Use this as an opportunity on the first page to list, what are you paying, what's your federal rate? What's your Social Security rate? If you're an S corporation, you do pay Social Security taxes on your wages. So you may or may not be paying the full boat on all of your profits, but to the extent that you are a business owner, the IRS requires you to pay a reasonable salary and pay Social Security taxes on your wages. So for a lot of business owners, quite frankly, a reasonable salary is all of their profits. The lady I'm talking about, if she was an S corporation, her income's $32,000. What should her salary be? $32,000. She's still going to pay 15% Social Security taxes as an S corporation because the company pays half and she pays half. So you don't avoid it. Okay? So that's important, I think, as a starting point, that the common tax planning mistake that business owners make, I think, in tax planning is you don't know your tax bracket. Now, for the lady I met with from Fort Thomas, she's very incentivized now to make sure we maximize the deductions. That's important. Now, why did she come to me? Because the IRS is auditing her because she did her tax return on TurboTax, and I identified where she made the mistakes on her TurboTax tax return. That's why she got audited. She got the letter and called me the next day. Found me on the internet, marketing. Search engine optimization, it does work. So take a minute, if you can, to identify what your tax rate is. So you can go back to your CPA and say, how much am I paying in taxes? And quite frankly, she was shocked. She was just so livid after she found out how much she was paying in taxes. She says, I'm going to have more people. I'm going to grow my business. I go, well, that's great. Okay? Which led into the next point I'm going to talk about. Okay? As a business owner, the first thing I talked to her about is, and this is the tax planning mistake number 2. The tax planning mistake number 2 is your failure to maximize your 401k, your simplified employee pension plan, your simple IRA, or your IRA deduction for business owners so that you can try to maximize your retirement contribution. And we also typically want to minimize what we pay the employees. I mean, I'm just saying we're just not that generous. Most business owners are trying to save taxes, but the problem you have sometimes is that if you try to maximize your pension contribution, you might be, all the tax savings might be going to your employees because there are minimum requirements you have to have with a pension plan to contribute money for your employees. But a pension plan, I believe, is the best tax shelter out there for business owners. For my lady from Fort Thomas, the example was that, well, you won't save Social Security taxes, but if we take 15% off of 46, you're at least saving a third in income taxes today. So that we give her motivation, if you think about it, that if I do put $10,000 into a pension plan next year, so I can make more money, and to avoid taxes, I put it into my retirement account and I save taxes, I only have to pay 15%. I like that idea. Okay? So again, the thing that I would focus on that's out there that's also a misconception, I believe, is a lot of people are out there advocating that you should have a Roth IRA. The people that are advocating that are a lot of times financial advisors that are not tax advisors. And having worked on this a lot since they put the Roth IRA in 30 years ago, I found that if you're the question becomes, do you believe that you're going to be in a higher tax bracket when you retire? Now think about that. I don't have many clients that retire with an IRA account over $1 million. Let's assume that you would be very successful and you try to put away money in and year out. Do you think you're going to be able to accumulate over the next, till you're retired, $1 million in your IRA? So you're going to take that money out when you retire? Let's assume that you are successful in doing that. And when you're age 70, you're required to take out the required minimum distributions. It's 6%. So if you're married, you'd be able to take out $60,000 a year. Now, we just went through the tax brackets. You have Social Security typically in your IRA. Are you in a higher tax bracket when you retire? Keep in mind these tax rates have been indexed for inflation the past 30 years. Okay, so while that's the thing that, because I've been practicing over the years and I've experienced it, these tax brackets keep getting larger at the lower tax rates. So the whole assumption that you're going to be in a higher tax bracket when you retire for the average person defies logic with me, which says you would not need a Roth IRA. Okay? You would want a tax-deductible IRA because you're going to be saving taxes at 25%, and hopefully you're going to be in a 15% bracket. Do you really think that Congress is going to be taxing retirees at a higher rate when in your 70s. And by the way, let's say you're in the same tax bracket. Guess what? It's a break even, it's a wash. Doesn't matter. You have to be in a higher tax rate to lose on this deal. There's one other factor that people don't talk about. We do a lot of elder law planning. What's that mean? Age 65, the baby boomer. Your average life expectancy will be age 83. 1 out of 4 will live to age 90. 1 out of 10 will live to age 95. That's in my Social Security statement I just got this year. Also the statistic, 2 out of 3 people age 65 will be needing nursing home care before they die. And we all know what the cost of nursing homes are currently. And usually it's end of life, quite frankly. It could be a year or two. The average stay, though, in a nursing home is 4 years. The American Institute of CPA has a guide for elder law planning when I'm working with clients to do retirement planning. You should budget $250,000 at age 65 to plan for your medical expenses from age 65 during your retirement years. If you're married, you need $500,000. Now, how does this tie back to the IRA? We work with clients all the time that they accumulate money in an IRA, and when they go in the nursing home and they're paying $100,000, we take that money out. And guess what? You get a medical expense deduction on 90% of your nursing home care cost. Guess what? I want a pool of money in an IRA that I can do some financial planning and tax planning when you're older, that you can have more money to pay for the nursing home. That's the whole strategy. I do encourage clients, if you do a tax-deductible IRA, to put that extra money that you're saving in taxes into the IRA so you have a bigger nest egg. Okay? So you know, if you're in this example, if you did a Roth IRA, you'd be doing after-tax money at $10,000. Well, I don't want you to do that. I want you to go ahead and goose it up another $3,400. If you're over age 50, you can put $6,500 and $6,500. If you're a married couple, you can put $13,000 into IRA, tax-deductible IRA. So that's the example I'm giving you, that I want you to maximize what you can put into. I want you to take the tax savings and I want you to put it into the IRA. So the tax planning mistake number 2, where you don't maximize your pension contribution, I think that's something you want to review with your CPA. As a business owner, you're typically trying to balance things out. I'll give you an example of my situation. I have a simple IRA. Now, I could try to put more money away into maybe a 401k with my employees, but guess what? With a simple IRA, my minimum contribution for all my employees is 2%. So there's actually a cost that I have for me to put, $15,000 into a simple IRA. And I'm going to save, what, $5,000 in taxes. My payroll is nearly $400,000. What I'm trying to tell you is that I'm putting money away, but guess what? All my tax savings is going to my employees. Now, if I did a 401k, I'd have to put 3% in. Okay? So I'm giving you an example that most of the business owners I talk to, we're trying to do strategic planning, and we have to look at the overall picture. So in my situation, the simple IRA allows me to put some more money in, but I wanted to contribute, and I have my employees have been with me for a long time. It's part of their compensation package. That's how I look at it. So when I do their annual review with compensation, we have their income, bonuses at Christmas, and then we also look at the health insurance that I pay 100% of. We'll be talking about health insurance cost. Is another thing that business owners need to deal with their employees. So I think for your purpose, I don't know if you check the box, yes or no. Is that something that you need to talk to your CPA about? Tax planning mistake number 3. Here we go. And this leads into the medical expenses. Tax planning mistake number 3 is the failure to fund your HSA account, your health savings account, annually. This is almost, to me, if you have a high deductible plan for insurance, you get a tax deduction to put money away into an HSA account. You can invest the money there. It accumulates tax-free. And when you take the money out, there's no tax that you pay on the income and earnings that you have in your HSA account. It's a no-brainer. It's a nice tax shelter on top of the retirement accounts, even better than the quite frankly, the retirement account, because when you do the IRA and the pension plan, you got to pay tax on it when you take it back out. Here, you can put money into the HSA, you can invest it, you can accumulate it. You don't have to take the money out for medical expenses. When you're age 65, you can't put more money into the HSA anymore, but you can take money out of the HSA and use it for any purpose. Okay? So that's another one common mistake that business owners make, that they don't put money into their HSA account annually. Tax planning mistake number 4, the failure to keep adequate receipts for business expenses, and you risk losing tax deductions if you're audited by the IRS. My lady that came in from Fort Thomas. It's one of those things that I would tell you there's 3 really important strategies for not worrying about an IRS audit. You know what the 3 strategies are? Documentation. You know what number 2 is? Documentation. You know what number 3 is? Documentation. I've been through audits for the last 40 years. If you have documentation, signed off, no problem. You don't have a documentation, disallowed. IRS is getting tougher, I got to tell you. They've been training agents, or this lady got audited. She actually got audited for several reasons, but the thing that concerns her is that does she have the documentation to substantiate what she has deducted on her tax return? And let's talk about credit cards. I always recommend clients use a credit card for business and credit card for personal, so it helps you identify when you're making the purchase that is a business expense. So if you can do that, that's good. Sometimes there's an overlap, but I recommend that. I also recommend you use a credit card for your business like I do, and you get the points and you get to travel. I've been doing that for years. I'm talking about years. So I try to put everything I can on my credit card. I pay it every month. There's no cost then. And I get all these points and I get to travel. It's great. I love it. Okay? Actually, the best credit card, I will tell you, is American Express Starwood Preferred. Excellent. The hotel rooms at the Sheratons and everything are fantastic, and you get more bang for your buck than having a Delta card that gives you 1%. You get 2, 3, or 4% on your travel. So it's been fun. But let's talk about the credit card. The credit card is a proof of payment, but it's not a receipt for tax purposes. I've been in audits, and if the client cannot come up with the receipt that backs up the payment and the charge on a credit card, disallowed. The IRS doesn't know whether it's Amazon or Office Depot or whatever, whether the expense was you went out and bought all your groceries for your family or you bought something for your house. They want to see the receipt. So you know what? There's a simple solution. The solution is you have an envelope every month. Just stick your receipts in the envelope. Just keep your receipts. And if you get audited, you pull out the envelope, and at least you got the receipt, and then you go through it and you organize it and sort it out month by month. And that's why you might want to put the receipts in an envelope every month. Depends on how much you use your credit card. But it's real simple. If you're paying by check, keep a receipt. Just have a receipt for everything. That's all you have to do, and you're okay. Now, how do you report your income? I always tell you, if you're audited, they want to say, and if you have any cash, you say, I put all my revenue is deposited in my bank account. You got to have that as a policy. I'm not trying to tell any business owner that they should cheat on the government and the law. So we got to report all the income, but we try to save taxes by maximizing the deductions and making sure we have documentation for those deductions we have. Now keep in mind, you just don't spend $1 to save 46 cents. So you only buy things that you really need. Otherwise, you're going to be ahead if you maximize your profits. That's okay. I'm okay myself if I can pay more taxes. It's a better year than last year then, right? Nothing wrong with that. But I'm still there trying to do what I can in the pension plan, the HSA, and I want to make sure that my business expenses, and that's another thing that you look at, that if you know you're going to have an expense typically within the next 6 months or so, you can accelerate that expense into, it's too late for 2016, but this is the time to do planning for 17. And so when you do your business plan, you want to start planning the end of the year, what receipts you may be, what purchases you may want to be making. So you might make them in the end of the year to get that tax write-off. You might prepay some expenses. I did that last year for purposes of Trump. He's supposed to reduce taxes for business owners, right? We don't know if it's going to be 15, 20, 25%. So my strategy was to go out and prepay advertising expenses, prepay expenses for my tax return processing fees in order to save taxes in 16. I knew my tax rate isn't going to be higher, but it could be lower next year. Tax planning mistake number 4. Fair to keep, well, that's what we discovered. Sorry about that. Let's go on to number 5. Tax planning mistake number 5. Fair to maximize your business expenses for the business use of your autos. There's the actual versus the per mile method. Fair to maximize your business expenses for travel expenses. The actual versus the per diem method. And also the home office deduction. Don't shy away from those deductions. You will not be audited because you have a home office. There's a simplified method you can use that you can deduct $5 a square foot up to 300 square foot, maximum deduction $1,500. You can get that deduction. It's a free deduction. Now, the important thing is that must be the principal place where you conduct your business, and there's all kinds of rules that you need to talk to your CPA about to make sure you qualify for the home office deduction. If you have an S corporation, you cannot qualify for the home office deduction. I can tell you that. There's a ruling on that, okay? But if you have a car, you can use the actual method, or you can use the per mile method. It's real simple. If you have a lot of miles, you want to use the per mile method. If your miles are low, you want to use the actual expense method. You get a bigger deduction. You should keep a log on your miles. The IRS is going to audit that. Now, one method would be you keep your miles every day. Keep in mind, if you're an employee, the first trip and last trip are personal. So it doesn't count. But if you're a business owner and you have a home office, any mile you drive for business is tax deductible. You don't have the first trip, last trip rule. Okay? So that's important to know. And I would say for travel expenses, I had a client audited. Guess what? Business owners are not allowed to claim the per diem method for business travel, where you just say, I was out of town overnight, so I get to take the $100 or the $150 per day that I'm out of town overnight. If you're a business owner, you're required to prove the actual expenses. And the IRS is getting sharper because I had a client that they nailed him on it. If he didn't have the actual expense, guess what? No documentation, guess what? Lost the deduction. Okay? So these are some of the strategies that you use to try to maximize your deductions. Why? To save taxes. What's your tax bracket? It adds up. The common tax planning mistake, number 6, is you improperly classify workers as independent contractors when they should be employees for payroll tax purposes. Common thing with business owners. Oh, I'm just going to have a 1099. And I say, oh my gosh, you are walking on thin ice. You have to be very, very careful with this whole issue of independent contractor versus employee. Yes, if they really truly are an independent contractor, we can structure it to qualify for that, but you got to be careful. I'll give you an example. These are live stories. I always tell the stories that just happened recently, not over the last 40 years. He had a client. They had 1099s for everybody that worked there. Isn't that a flag, kind of? Okay. They weren't caught. No problems all these years. They hired a guy last year, and they terminated him after 3 or 4 months. He walked down to the unemployment office, triggered an unemployment claim. They came in and did an audit, everybody. 3-page questionnaire regarding exactly what every employee did. Every employee, he had to fill out a questionnaire. Came up with a $26,000 assessment for unemployment taxes the last several years. They bumped up the rate. Normally you're paying 2 or 3%, usually around 3% of $8,000 a year. The rate was 10% for 3 years. They're paying $800 per employee plus interest and penalties. Guess what? That's just the tip of the iceberg. They're still appealing that and trying to fight it because if they are liable there, then the fear is the state's going to turn it over to the government, and you got workers' comp issues that you're liable for. You have federal unemployment taxes. And then you have the payroll taxes you should have been withholding on these employees. That the business owner is personally liable for the payroll taxes that they should have withheld. Not just the business, it's personal liability. For the state withholding taxes, for the federal withholding taxes. even though that was for they paid their taxes, and so there's all kinds of complications there if you get in this problem. And all the Social Security taxes you should have withheld. You do not want to err on whether you have an employee or an independent contractor the wrong way. And so I do have some handouts, quite frankly, and we don't have time to go through them. This is intended to be a workshop. I got some tools for you. If you go back into the back, the very back, there's an article, the last 3 pages, that talks about the whole issue of independent contractor employee. And right before that, you're going to see the IRS audit technical guidelines when they audit you, okay? And if you, at the top of the page, there were 20 pages. I didn't copy them all. But what I would highlight is page 16 in the very back of the handout. At the very bottom, it talks about that the IRS determines the right to direct or control. They look at your behavioral conduct, financial control, and the relationship of the parties. So there's 3 issues, okay? This is what you need to talk with your CPA about if you have independent contractors, to make sure that you're dotting your I's and crossing your T's. That old thing, an ounce of prevention is priceless. Okay? Tax planning mistake number 7. The failure to properly use the proper tax entity to maximize your income tax savings. The biggest mistake is the failure to maximize your Social Security and Medicare taxes by using S corporation properly. So, the point is that if you are an S corporation, you have to pay a reasonable salary. But if you have profits in excess of a reasonable salary, you can pay a dividend on those profits and you pay no Social Security taxes. It's a no-brainer. And so the question I have with businesses, that whether they should elect S or not, once the business owner is making more than a reasonable salary, they should consider being an S corporation. Okay? So that's one of the biggest things that a business owner can do. Now let's do some planning. Let's talk about this. A business owner makes $120,000. The Social Security taxes are 15% on that income if you're a sole proprietorship, or if you're a partner in a partnership. Your self-employment earnings are at 15% of $120,000. Do the math. $18,000. Now, what if your reasonable salary is only $60,000 instead of $120,000? How much do you save? Per person, per business owner that's making that kind of income. We also do Social Security planning with couples and understanding the Social Security laws. Because I've had some clients that one spouse is paying $60,000 and the other spouse is paying $60,000. So they're each earning Social Security of $60,000. Now, if you know when you retire and you've been married for more than 10 years, if you change it to have one person be paid $120,000 to maximize their Social Security benefit, double it, the other spouse doesn't, when they retire, this spouse gets the Social Security on $120,000, and the other spouse gets 50% of their benefit. If that spouse, upon the death of that spouse, the surviving spouse gets that benefit. Okay? So I'm saying there's some planning involved when we look at business owners trying to do Social Security planning, trying to identify how much are you paying each spouse for their Social Security taxes. It's an important issue to look at, the choice of entity. I have a separate outline that goes into a lot of detail, and there's 5 pages that talks about the tax planning issues, whether you're on page 3 is a sole proprietorship, a partnership, page 4 is a C corporation or an S corporation, and page 5 is an example. And I want to share this with you. A lot of businesses should not be a C corporation. And this is the example on page 5 there that shows if you're a C corporation and you sell the business, you're going to pay double tax on the gain on the sale of the assets, the business assets. And if you're a C corporation, you don't get the lower tax bracket, 15%, 20% on the capital gain. All capital gains in a C corporation are taxed at the maximum corporate rate of 35%. So if you are a C corporation, you need to do some tax planning with your CPA to try to see if you should be electing S corporation. A lot of times you'll elect S corporation at least, right now it's 5 years before you sell the company, because then if you are a C corporation and you elect S corporation and you're an S corporation for 5 years, You avoid the double tax, and all the capital gains are taxed at lower rates. So if you are a C corporation, there's some planning involved with you as far as your choice of entity, whether you should or should not be a C corporation. Tax planning mistake number 8. Failure to maximize tax savings for business owners using the cash basis for reporting taxable income or other methods to defer income legally. There's some legitimate tax planning to be involved if you're a business and you qualify to be cash basis. Now, what does that mean? I had a new client that came in that was a web design company. They just provide services, consulting, or they actually do the web pages and stuff. And so they could be cash basis. They were paying tax on their accounts receivable, money they didn't have. They didn't have that much in the way of accounts payable, so there clearly was a tax advantage for them to be cash basis. That's something, if you're a business owner, you should be looking at, particularly if you're a small business owner. Even if you sell inventory as a small, that's one of the rules for, if you sell inventory, you can't be cash basis, except if your sales are under $1 million. You can do what's called a modified cash basis, and you don't have to pay income taxes on your accounts receivable if you're a small business owner whose sales are under $1 million. These are examples of why you should be working with your accountant to make sure that you're trying to do everything you can not to report income and pay tax on it if you don't have to. Construction contractors are another big area. When you have a contract and you have a construction contractor, whether you use the completed contract method of accounting, the percentage of completion method of accounting. So I've worked with a lot of contractors over the years. So that's another issue that we look at, as to whether or not, if you're a contractor, whether you should use the completed contract method of accounting, which enables you to defer the income until the year in which the contract is completed. Under percentage of completion method, you report the income pro rata as you earn the income in the contract. So you accelerate income before the contract's completed. The tax planning mistake number 9. Failure to use depreciation methods to maximize your tax savings. There's Section 179. There's bonus depreciation. There's also accelerated depreciation methods. Are you working with your CPA to properly plan how you're writing off your equipment, your car, your furniture and fixtures? Are you doing the right thing for your business and for yourself to minimize your taxes? What I'm trying to say is that my experience has been with most CPAs out there. They don't do any planning. They just maximize the deduction. I've had clients come in and they're maximizing the deduction, and they're getting the deduction at very low tax rates. The client has a bad year, and they're still maximizing their depreciation deductions. And what that means is they're throwing the deductions away. So sometimes it may be better to use straight line depreciation, a longer life on a straight line basis, instead of trying to accelerate the depreciation. Sometimes it's better not to use Section 179. Section 179 relates to new equipment that's purchased that you're allowed to write off the whole cost. Now, if it's a car, you're limited to $25,000 under Section 179. That's not bad. So I had a client that went out and bought a $50,000 car. He was able to write $25,000 off last year. He's big income. Yet then, the remaining $25,000, you can take bonus depreciation. Bonus depreciation says you get to write off 50% of the cost of the vehicle. So he got to write off another $12,500. We're up to $37,500 deduction for a $50,000 car he bought in December, right? And then then you use the depreciation methods. Now in his situation, there's a special rule. If you buy the assets at the end of the year, you don't get to take the depreciation, okay? But he got $37,500. I'm not going to complain about that, okay? So these are examples where you work with your tax advisor to try to find out how do you maximize your depreciation deductions. And sometimes it's better not to claim Section 179, not to claim bonus depreciation, because you got to look at your overall tax situation. You want to maximize your deductions, but you don't want to be using those deductions at lower tax rates, right? You don't want to take those deductions and throw you into a 15% bracket. You're losing money in the long run. Tax planning mistake number 10. So we're getting down to the end of the wire here. The failure to reimburse employees for business expenses using an accountable expense reimbursement plan or other methods to pay for dependent care, medical premiums, and medical expenses on a pre-tax basis. So if you look at the whole idea of an accountable expense reimbursement plan, if you're an employee of a company, so you might have salespeople working for you, you pay them to drive their car, and if you don't necessarily reimburse them on a per mileage basis, and if you don't do that, then guess what? They have to try to claim that deduction on their personal tax return. It's a Form 2106, employee unreimbursed business expenses. It's a miscellaneous deduction. 2% of their income is not deductible. Okay? They have to take after-tax dollars after they pay Social Security taxes on that money. The company pays 7.65%. The employee pays 7.65%. So, again, if you don't try to structure an accountable expense reimbursement plan, it has to be in writing. That's the only basic requirement. There's some guidelines you got to follow. But it's a great strategy to have employees paid on a pre-tax basis for their car expenses. And we also try to maximize, because medical expenses are so expensive, to allow the employee to pay for their health insurance. Even if they pay for it, we can do a cafeteria plan, a Section 125 plan, that allows the employee to use their compensation to pay medical premiums on a pre-tax basis. There's some special rules with Obamacare, so you got to be careful about that. There's also other strategies. It's called a health reimbursement account, a flexible spending account. These are all terms that you need to discuss with your CPA to try to identify whether you should be working with your employees to maximize them having these expenses on a pre-tax basis. When you do that, the company saves almost 8% in Social Security taxes. The employee saves Social Security taxes. This goes back when I first started in accounting. I had a car allowance of $300 a month. I had to account for my mileage on a pre-tax basis to my employer, and so that income was tax-free. It's not that hard to do it. It takes a little bit of effort, but you really can save some good money depending upon how many employees you have. Okay? Also, if you're an S corporation, you're a business owner. You want to make sure the company reimburses you for all of your business expenses, because you don't want to try to deduct it on your tax return. Remember, 2% is non-deductible of your income. So as a business owner, you want to reimburse yourself for mileage, for travel, for entertainment, and all those goodies, and you put it on the corporate tax return, which is not audited. Okay? When we have clients that are audited for these employee expenses because the company doesn't do it, the IRS takes the position, they say, what's your company policy? And they've taken a position now that they say, if the company doesn't reimburse you as an employee, we think it's unreasonable and we're not going to allow the deduction. That's the position they're taking now. So they've even taken a step further. They're saying that you can only deduct ordinary and necessary business expenses. And they're just coming out of the box saying, you know what, for audit purposes, if we audit you on unreimbursed employee business expenses, it's unreasonable. It's not necessary because the company policy they made a determination when they didn't reimburse you that it wasn't reasonable and necessary. Isn't it crazy? So we've gone through the top 10 tax planning strategies, basically, the common mistakes that business owners make. It's intended for you to be a workshop. I would add by each of the questions, the tax guide. Here, there's numbers. So there's information in the tax guide. This tax guide is also online at heschcpa.com, and you're able to go into the tax guide if you don't have this with you. But each of these categories, I identified pages in the tax guide where it talks about that particular common mistake that business owners make. So with that, we're going to take a break. It's 9 o'clock, and we'll probably be back in, let's say, 10 minutes. Thank you.